Hey guys, how's it going? Option Sniper here with you at 12:15 Eastern Standard Time. So we only have 6 people watching. That can be a good thing because if you 6 really want to interact, we can definitely get the most out of this hour. So please, all 6 of you that are watching, do not be shy, okay? Take advantage of this. Take advantage of it. This can be like a very personalized 60-minute session. I'm going to cover some things that Dave wanted me to cover, and I'm also going to try to talk about a couple new things, just so to keep kind of everyone engaged, I guess because we're doing some review today, and then I'll bring in some, I guess, different kind of more exciting stuff, and then we can, depending on how that goes, maybe we don't get to all that if you guys start engaging a lot, then we can I'll just go off script and start, trying to help you guys in any way possible. So, all right, so I'm going to start here, and then I'm going to check back every 10 minutes or so to see if there's any questions. But like I said, the 5 people that are in here, please take advantage of this time. Please ask any questions, like whatever you want to talk about, okay? We can go off script. You guys, whatever you guys want to talk about. I'm just going to cover a couple things. It's probably going to take about 15 minutes, and then I'm going to check back and see what's going on. All right, so guys, there's still a lot of people having trouble with money management and discipline. So I'm going to try and go a little bit further into that today. Okay, so I want to emphasize this. The first thing as traders, okay, when we are trading, before we enter the trade, I know I've been driving this home over and over again. Before we enter our trades, we need to first identify our risk, our stop, and then take that to the dollar amount, right? So once we figure out where our stop is, so the first thing before we enter the trade, the first thing we always need to do is take into consideration and think about the losing side of the trade, okay? Because it's very possible. It's very possible. Like the best traders in the world are only right 50 to 55% of the time, okay? So before making any trades, we need to identify our risk and our stop. And then once we do that, once we identify our risk and stop level, price levels on the chart, we then need to figure out the exact dollar amount we stand to lose. Okay, so you do this by looking at the delta on the options, right? So say you have a 50 delta and you have a $2 stop, you're going to lose $1 per contract. Okay, you get that? The 50 cent delta times $2, that's $1 per contract. You're going to lose $1 per contract. Now, say you want to get 15 contracts, you're going to lose $1,500, right? Okay, so if you're wrong, you're going to lose $1,500. That's like the point you need to get to. You need to know exactly how much money you're going to lose if the trade doesn't work. Before you even enter the trade, this is the first thing you need to know. Okay, now what you need to do is you need to get in that mental state of losing that amount of money. Okay, now this is the exact opposite way that you should be using your mind, but this has to be done just once before every trade because you need to know how you're going to feel if you lose that money, okay? So, basically think of it this way. You stand to lose $1,500 on this trade. Think about taking $1,500 bills and just burning them, okay? Throwing them in a fire. Think about how would that affect you? How does it feel to lose that $1,500? If once you get into that state, you'll know whether or not you're okay with losing that. Okay. And then you can go from there. If you have, a couple $100,000, maybe that $1,500 is not going to really impact you. If you have a $10,000 account, then yeah, that $1,500 is going to hurt. And if you have a $10,000 account that you're using to not just trade but do other things with, then yeah, it's going to hurt even more. So you have to get to that point where you're always aware of how you're going to feel when you lose what you're risking, and you always need to know what you're risking. Okay, never enter a trade not knowing what you're risking. That's how you can really, really harm yourself. And Dave wanted me to talk about this even more today, because there's still a lot of people struggling with this. And money management, if you can't get down money management discipline, you will never be successful trading. Never. You're destined for failure if you don't have money management discipline. So like, you could be the best technical chartist in the world, whatever. You identify X amount of trades, always, whatever. But at some point, you're gonna go on a streak, even if you're right 50 to 55% of the time, like the best in the world. If you're right 55% of the time, there's still a high probability that at some point you're gonna have like 10 losing trades in a row. And if you're taking so much risk that you can't handle 10 losing trades in a row, that's going to decimate your account, then you have to adjust your money management and your trading plan and trade smaller and all that stuff. Let's see here. Did I cover everything on this slide? Yeah, and I mean, it really comes down to, guys, thinking about, you need to identify before you get into a trade what you stand to lose and how you would feel if you lost that. And if you have enough capital to absorb that loss. So does anybody have any questions? Okay, we have 8 people now. That's good. Okay, so the 3 people that came in while I was talking about this, I want to emphasize that we're trying to make these sessions as interactive as possible. That's why they're live. There's a big difference between just making a recorded video and doing this live. So the more that you guys interact with me, the better. You guys. Eventually, I really want you guys to come with what you want to talk about, and then we're just totally off script, and we're just going over whatever it is that you guys want to talk about. That's the advantage of being live, vice just recording something. So let's take full advantage of that. But I'm just going to keep going. Okay, so these rules are like, you have to follow these rules, okay? Like I actually took a decent amount of time to put these rules together for everybody. This is like a blueprint to making sure that you keep yourself in the game and making sure that you don't blow yourself up trading options, okay? And it's tailored to the Standard Rally Exchange and the notifications that we send out. So moving forward, this is always going to be a slide that we have in the presentation, and because I share these slides, and I want everybody should have rules, okay? Everybody should have a trading plan, and everybody should have trading rules, right? These are things that govern your trading, that ensure that if you're just doing everything off the cuff, if you're just shooting from the hip in everything that you do in the market, your emotions are eventually going to get in your way of your success. So if you have a blueprint, if you have rules and a plan for yourself, it doesn't matter how you feel emotionally. You're not going to be. It doesn't matter, because am I breaking my rule? At the end of the day, that's the question that you ask. And if you are, then you're not going to be making emotional mistakes that you would if you didn't have a plan and you didn't have rules. Okay, so we're going to cover this slide again just briefly because this needs to be driven home, because there's been a lot of people still struggling with the money management part. Okay, so this is another example. I'm going to try to explain this again, and please let me know if some of this doesn't make sense. We're using a $10,000 account, and no matter what the amount of money is, we're using a $10,000 account as an example. But no matter what size your account is, these percentages should be what you stick to when you're trading. So how the rules that we want to follow here for managing our money and making sure we're not taking too much risk are, we only want 3% of our account max in weekly option trades. Okay, so weeklies they expire this front Friday. That's what a weekly is. Okay, we want another 3% that expire greater than 7 days and less than 30 days. Okay, because inside of the 30 days, whenever you get inside of 30 days on options, theta, which is time decay, greatly accelerates. Once you get inside of 30 days, theta accelerates, okay? So that's time value. Your option starts losing more value faster due to time decay because you're getting closer to the expiration date. So another 3% that it's greater than a weekly and less than 30 days of the account, okay? So 3% in weeklies, 3% between 7 and 30 days, that's 6%. And then 5% that goes out 30 plus days. Okay, so I'm going to stop here and I'm going to say all the trades on the Centrally Exchange, you can use different expiration dates, right? So if most of the notifications that Dave sends out, if they're all on weeklies, then once you get to 3% of your account in weeklies, go out longer in expiration and you can still use the idea, okay? And you can still sell whenever he says to sell. Whenever our site says to sell, whenever we send that notification, you can still sell. But this way, you're staggering your expiration dates and you're taking less risk. Okay, you do not want anything more than 3% of weeklies in your account. It's just way too risky. Holding those things overnight, way too risky. Okay, so when you go out, and the other thing is when you go out over 30 days. You can put 10% into a trade and assume that you're risking half of that, okay? Because when you go out 30 plus days, you have a lot more margin for error. You have a lot more time. It's a lot safer. So you don't have to assume that you're going to lose everything you put in. You don't have to assume that everything is at risk that you put into the trade if the expiration is greater than 30 days. You can assume that half of what you put into it is at risk. So you can actually put 10% of your account into expirations that are over 30 days, assuming that only half of it's at risk. So with this plan, you will max have 16% of your account in options at a time, okay? 16%. And you will be risking 11%, right? Because the extra 5%, that's plus 5, that's over 30 days. So this is perfect, guys, okay? If you're only risking 11% of your account on options, you will survive, okay? You will survive no matter what size your account is. Some may say maybe 11% is too high. And if that's too high for you, you should adjust, but you need to ask yourself, is this too high? Okay? And this is this is really the max, guys. Like even if you have a $5,000 account, 10% of that's $500, or 11% of that, 10% is 500, so 11% is 550, right? So I mean, yeah, this is the guidelines that you need to stick to if you want to survive. Okay, if you don't want to blow yourself up, you have to follow these rules. I really went out of my way to make these rules for everybody. I have my own rules and money management plan that I follow, and trading plan that I follow, but mine is similar to this. Okay, it's similar to this, but this is like tailored perfectly for anybody and for everybody that is using the Centrally Exchange notifications. This is tailored perfectly for you. So please, please, please follow these rules. Please. Please follow these rules. And you guys will sustain yourselves through downswings, and you will be here for the long run if you follow these rules. Okay? And this thing that I always drive home is our delta should always be at least 50. Okay? Our delta should always be at least 50. It's just when the smaller the delta is on the option, the higher the chance is, the higher the probabilities are against you. Okay, so when you make sure that your delta is at least 50, you're putting the odds in your favor more. Does anybody have any questions? No problem, Zach. No problem at all. Yeah, feel free to watch this. This is the other thing, guys. I've been doing these videos every Sunday for the past, has it been 4 months now? So, at least an hour a week. So, I mean, that's at least, we have almost 20 hours of videos, of me going over various things. So we do have a pretty substantial amount of content now. And a lot of it's on this channel, and then we have some videos on other channels as well. We're gonna have to organize that and then bring them all together at some point. But I'll post the link for that, because we do have a lot of content, guys. So I really recommend that everybody watch the videos, and review them, and please focus on the money management ones first, please. Does anybody have any questions? Anybody have anything that they want to go over? If not, I'm going to keep moving. So I still don't see anything in the chat, so I'm going to keep going. Okay, now this is the other thing that people have been struggling with. I think the hardest thing as traders to do is know when the right time is to lock in profits, which is what a lot of people have been struggling with. And it's with options, your profits can evaporate so fast that you need to have a plan in place for managing that as well. So there's a certain point where once we get to a certain level of profits percentage-wise in our trades, we want to make sure that we don't give that back, okay? We want to always make sure that once our trade becomes profitable, we guarantee ourselves that we're not losing money anymore, and we at least try and take something out of the trade profit-wise if it starts moving against us. So a very important rule for traders, another critical rule for traders to use, is never let winning trades turn into losers. Now, there's rules and plans that you can put in place to do this. I'm going to give you guys a couple here. That doesn't mean that these are the only ones that anyone can use, but these are pretty good guidelines that you can use to make sure that when you have a winning trade, you don't allow it to turn into a loser. Okay? We never want to do that. Professionals take profits, right? So it's just going to be extremely difficult to have success in the market if we're letting our winners turn into losers. So a couple examples that you guys could use is once you get halfway to your target on your trade that you have planned out, you move your stop up so that say you have a $4 target, right? Say your target on the trade is you want the underlying to move up $4. Once it moves up $2, you now should move your stop up to stop out if it goes down $1 from there, is what I'm saying in this example. And I think this is a really good guideline to follow. This is one of my favorites. I use a high percentage of the time. Is if I have a $4 target on the stock, once it goes up $2, I'll make sure my stop is stopping out if it goes down $1 from there. So that way I know I'm locking in profits. and I'm not going to lose money on the trade. And that could vary depending on how volatile the stock is. That may not be a good strategy. Maybe it's if it goes up 50% to your target, like say if it goes up $4, once it goes up $2, then you move your stop to break even. So you give it a $2 cushion instead of a $1 cushion. It just depends on how volatile it is and how much you care about not letting profits evaporate as well. So yeah, I'm trying to work on some today too. I'm trying to remove the word from my vocabulary. So that's why I'm being more, it's hard to do, but I'm being more, see, I just did it again. I'm being more thoughtful about what I'm going to say. So that's why there's more pauses. Because what people do is they'll use the word or so or like to bridge the gap between them not saying any words. So it's something that I definitely need to get better at, because I know that I say way too much. But it's just like a habit that people have because they never want there to be a pause in words, if that makes sense. So I'm being a lot more deliberate and thinking more with what I'm saying, so I'm being a lot slower. And I just said again. So yeah, once we get to 30% profit on it, and then these are a couple other examples. Once you get to a 30% profit, so once you get a little bit, if you think 50% is too much, if you get to 30%, then you can move your stop to break even. Or you could make it so once you get to 50% of your target, you make sure you lock in even more than 25%. You make it 30%. But these are a couple examples and guidelines to follow. Let's see if anybody has any questions here. All right, still we have nothing in the chat. So I'm just going to keep going. Okay, I'm going to talk about the price action of the market a little bit this week, and then give an example of a properly planned trade, and then give an example if we have time. I think we're going to have time unless there's a lot of questions. Give an example of this earnings strangle this earnings strangle strategy that is designed to profit from a rise in implied volatility, where you do not hold it through the earnings report. You sell it before. Okay, so after every week of price action, I always look at the weekly chart on the S&P. It gives an even better picture of the overall trend of the market. And yeah, I mean, it just gives, it's my opinion, it's something that everybody should do. When the week ends, it's good to look at weekly charts of a lot of things, especially the indexes. So what we see in this weekly chart is we had 1 week where we sold off pretty hard a couple weeks ago. Then we rebounded the week before, and this week was just, we didn't really do anything this week, right? We opened and closed almost in the same place. We made a close high to where we were 2 weeks ago, and we didn't come anywhere close to the low. So what this tells me is it's really can go in either direction this coming week, in the next couple weeks. We could either head lower, down towards the 17 EMA, or we could continue towards 2400 and make new record highs. The important level to watch is the high of this week here, which I believe is 2382. That is the high that everyone should be aware of, is 2382. If we can close above there, then the market's should be able to get rallying again, and we should start a new bullish trend. And really important level is last week's low to the downside, which is, let's see. So let's get the exact levels here on these. So important high is 2382, and the important low is last week's low of 2345. Okay, so those are very important levels to both sides that we need to be aware of for this week's action. And the important thing here looking at all charts is to just identify the overall trend. The overall trend is we're in a bull market. We're in a pretty strong uptrend since Trump got elected, and all we're seeing here is just little correction of this last. I mean, we had 1, 2, 3, 4, 5, 6 weeks in a row where we rallied hard. We closed above the previous week's high. And after those 6 weeks now, we've had 1, 2, 3, 4, 5 weeks of correction of those 6 weeks. So we should, sooner than later, within the next couple of weeks, we should start trending again in some direction. This, guys, when this happens in the market, when we start after a big trend ends and we start chopping sideways, this is the worst time to be making a lot of trades. In here, you see these last 5 weeks. This is the worst when the market is just chopping back and forth. Is the worst time to be putting on a lot of trades. When we're trending, that's the easy time to make money. Like these last 6 weeks, that was easy money because it was just close above the previous week's high every time. And same thing with here, and same thing with here, same thing with here. And the important thing is to identify the cycles, right? The important thing is to identify the cycles of the market. Right now, we're in a chop sideways market, short term. Okay, so we're in a chop cycle. We are not in a trending cycle now. This is why it's better to not have a lot of trades right now. And we're going to know when we start trending again is when we close above 23.82 to the upside on the weeklies. That's when we will likely start making another upward move similar to this one, right? The 6 weeks in a row. And all you need to know the easiest thing to be able to identify if we're trending is if we close above the previous high on the previous candle, right? It's a very easy way to identify if we're trending in both directions. If you close below the previous week's low, or if you close above the previous week's high. So the lows and highs of the previous candle are always very important, and then you kind of go from there. The low of this candle is pretty important, but last week's low is more important of 23.45. And the high of this candle is also pretty close to, this is the important high candle here, 23.82. See if anyone has any questions. No questions. All right, we'll keep going. Okay, so this is the daily chart on the S&P 500. And what we see here is just the same thing, right? Extended out is daily candles that have just been chopping back and forth for the past 5 weeks. Now, what's important here is the 50 SMA is 23.45, which was also close to last week's low. So we did hold the 50 SMA last week, and that's going to be a very important level that the market needs to hold. And we're only 10 points away from that. And if we can't hold that, there's going to be a lot more weakness potentially to come. And if we can't hold the 50 SMA, the next really important level is the 23.25 area. Let's back this out so we can get the exact levels. So the next important level here is 23.22 if we can't hold the 50 SMA. This is the low here that we hit before we started coming back up. And yeah, and then this is kind of where the big sell-off started. So this is the high I was talking about of the 2 weeks ago. That if we get above that, it's much more likely that we're going to start a new trend to the upside. So that is that. Now, the one good thing we have going for the market right now is oil has been rebounding. So that's good for the market. When oil is coming up, there's a lot of oil companies that do not like to see the price of oil come down. So for the actual stock market, if oil's heading higher, that is good. Now, some of the reason why oil rallied is because of what happened in Syria, where we bombed Syria. So it's not rallying for all fundamental reasons. It's kind of rallying for geopolitical, which, may not be as sustainable if things calm down. We will see here. I guess the market really is more comfortable with oil in the mid 50s and has been. And if you see here, we kind of recognize this correlation, right? When oil took that huge dip, that's kind of when the market started getting weaker as well. So if oil can come back up in this range, that is positive for the market. So that is one good thing that we started seeing last week and towards the end of the week before, is oil started getting stronger. And like I said, the market sees that as a net positive, because there's a lot of companies that need oil to be higher to be able to make enough money on the oil that they're producing. Because if you guys do remember, it was only less than 2 years ago when oil was in the hundreds. So a substantial pullback like that is overall bad for the market. Now, for actual consumers, is the price of oil being lower good? Yes, but I don't think that offsets how bad it is for these massive companies, these massive oil companies. And that's an interesting argument too. Is the price of oil actually help? Does the lower price of oil at the pump actually help consumers? My argument is no. It's not like if you're paying $1 less per gallon of oil when you fill up your car, it's not like you're taking that extra dollar that you save and going to buy like a soda with it or something. You're pocketing those savings. So does that even really help our economy? In my opinion, no, it doesn't. It's not like the extra money that consumers save on oil is being spent in other places. So I think that's, I don't think that's a very valid argument. I can see why people say that sometimes, but I don't tend to think like that. So in my opinion, oil going higher is good for the market. And if we go back and look the past couple of years, the market has been very highly correlated to oil. When oil took that huge dip from 100 to the 50s, and I think it was like a couple month time span, the market sold off hard. And then once oil stabilized again, the market started rallying again. So it is important to be cognizant of, and that is looking good for the overall market. Oil starting to finally come higher a little bit, which doesn't actually make the most sense to me right now, because oil rig counts and supply is continuing to trend up, which all commodities are supply and demand. So if there's more rigs, then there's going to be more oil being produced, and assuming that demand stays the same, if you have more supply, that's going to cause the price of a commodity to go lower, because it's all supply. Commodities are all supply and demand. So the geopolitical is an interesting factor to this, but there's more oil being produced now than there was when oil was up here. So that's just something to be aware of as well, is that supply is trending up, which is negative for the price of oil, assuming that demand stays the same. Let's see if we have any questions. Okay, so Rick is asking about the Fibonacci's. He's saying he watched a couple of those. Yep, we did cover those the past couple weeks. And let's see, he's saying is for entry and extensions for exit. So Rick, it depends on, I'm not sure I understand 100% what you're asking in this first question. I watched a couple of videos. Retracement is for entry and extensions for exit. So the retracement can be used for both. So Rick, the whole point of the Fibonacci's is that it gives us a good ballpark area of when to enter into a stock when it pulls back. So if you want to enter into, say, example, right? We're using, if we just use the S&P 500, we're in a bull market. If we use the Fibonacci's, which we did in the past couple videos, if we use them, here, I'll just pull up this chart. I know where the big place where we used them, and that I'm still looking at, is from this swing down to this, from swing low to swing high. So it was from this swing low to this swing high is the fibs, right? So you go from the low to the high. And when you get that, on Thinkorswim, you're going to get a bunch of retracement levels at first. If you right click, you can edit it to however you want. I edited mine so that it's only showing the 382, the 50, and the 618, because those are the most important ones to focus on. So you draw that, right? So you draw from the swing low to the swing high. You're going to get a 682, a 50, and a 382. Now, those levels are important to be aware of, because once you get into the retracement zone, that's where you want to enter into the primary trend. Okay, it gives you a great ballpark area of where you can start to enter into the primary trend. The primary trend of our market right now is bull. We're in an uptrend. So the Fibonacci's tell us where we want to see the S&P pull back to before we decide we want to enter into this bullish trend. So that's really what it is. It just gives you ballpark levels. It's never going to be an exact science where the 50% is going to do something magical. It's just kind of giving you the percentages where when you retrace back into the retracement zone, it's a good place to look to enter bullish trades. And then if the S&P can't stay above the 682, right? Or I'm sorry, the 618, because there's a 382, the 50, and the 618. So if it can't hold above the 618 and it starts going lower than that, that's kind of the line in the sand. The 618 is the line in the sand where you say, okay, if it closes below the 618, now there's a higher probability that we're going to start trending lower, because we pulled back, and this pullback is now too aggressive to the downside, and now there's a higher chance that this uptrend that I'm trying to enter is not going to continue. So that's really what we use it for. We use it for the probabilities to identify things. Does that make sense? And then when you draw them on Thinkorswim and you go from low to high, lines are drawn with 0. No, it should be, if you draw from the low to the high, you're going to get 100% and a 0% on the peak and the trough. Now, I edit mine out, so I only see the 382, the 50, and the 618. You can customize it however you want. That's how I like. I think that's, for me, that's the way I like it, because those are the levels. The 382, the 50%, and the 618, those are like the important levels to focus on. And I like to keep my chart as simple as possible. I don't like to load it up with a bunch of stuff, because the only thing that really matters is price. And so that's why the Fibonacci's are so powerful, is because it's all derived off price as well. It's not like indicators lag. So like the MACD and stuff like that, they're lagging. They're showing us the past. So just because you're getting like a bullish cross on the MACD from what happened in the past doesn't mean that like the market's not going to sell off the next day, right? It's just indicators are lagging. They're good to use as kind of like training wheels, but when you get to the point where you can just use price, that's, in my opinion, that should be the end goal. And then you can use an indicator or two to kind of confirm what you see with price. So yeah, that's why for me the Fibonacci's are such a powerful tool, because you want to be entering primary trends on pullbacks, and that's kind of what the Fibonacci's help you with. They give you the levels where it's a good place to enter into the primary trend. Because in my opinion, you don't want to be entering into the primary trend. You don't want to be chasing it higher, right? Some stocks are momentum stocks, so if they make a new high, sometimes it can be a good strategy to ride momentum a little bit. But if you want to enter a trend for the longer term, you want to enter it on a pullback. So yeah, I hope that helps, Rick. Let me know if you have any other questions, because like I said, we want to make this, there's 5 of us in here, we want to make this super interactive, and I want to allow you guys to get the most out of this 60 minutes. And that's what I'm here for, is to interact. That's why this is live, right? So I will check back. Let's see here. Okay, so now I just want to talk briefly about my kind of favorite ideas of this earnings season. So my favorite ideas are, I like CACC as a bearish type opportunity because fundamentally, new car sales have greatly decelerated, and CACC is a auto car loan lender where 80% of their loans are 650 credit score or lower. Or I'm sorry, not 80%, 98%. I believe the number is 98% of their loans are to people with credit scores of 650 or lower. So they have a lot of bad credit loans out to people that buy cars. They loan to people that buy cars. And that trend has slowed down. The trend of buying new cars has slowed down. Also, the creditworthiness of people has also slowed down. I'm sorry about that. If you guys can hear, there's a car alarm going off somewhere around me. Okay, they just turned it off. That was kind of distracting. But so yeah, I like CACC for a bearish, and these are both like longer term, right? CACC is reporting sometime in early May, and with both of my kind of, I don't do a lot of earnings trades because to me it's very risky. It's kind of like, similar to just betting or gambling. But when you have when I have my fundamental reasons behind it, that's when I get a little bit more confident. I think I kind of shift the odds in my favor a little bit. And so with CACC, fundamentally, we're seeing new car sales greatly slow, so less people are taking loans. And we're also seeing more loans defaulting as our economy reaches the peak of our economic bullish cycle. So I think, those things can cause CACC to have a less than stellar report, although it may take a couple more quarters to kind of really rear its head. So this may not be the best quarter. Maybe the July or August quarter is a better time to do it. But it is something I have on my radar. It's one of my favorite ideas right now, is bearish on CACC, longer term, right? So when I say longer term, I mean 40 plus days in expiration. Bearish on CACC. And I am bullish on Wynn. What we've seen here with Wynn in the casino operating industry is the trend has finally started to pick back up. For a long time, they were in a bearish downtrend where gambling revenues were kept decelerating. January was the first quarter where we saw acceleration in gaming revenue. And it was really the first good quarter for casino companies in a couple of years. So gaming revenues are projected to grow at a faster rate, right, to accelerate. Wynn had an awesome quarter in January. It was kind of their first good quarter in like 2 years. So I'm bullish on Wynn for like the next 40 plus days. And yeah, if you can see in here, last quarter they reported the end of January, and they had a pretty big gap to the upside. I think I have the weekly chart. This is the weekly chart on Wynn. Okay, that's why it looks like that. So I had the weekly chart on Wynn up there. So let's take a look at the daily. So yeah, I mean, Wynn, their last time they reported was like their first really good report. You can see here they gapped. This was the last time they reported. They closed, 95. Next day, hit all the way up to 103. So that's like a 9% move, right? So Wynn's a very good stock to trade options on. It has good implied volatility, good enough liquidity. The bid-ask spreads aren't terrible, and it moves a lot. Okay. And so you see, like, January was the first actual really good quarter for Wynn in a long time, and the trend for gaming is now starting to pick up for the first time in a couple years. And I think that we're going to see this quarter. Wynn's earnings date hasn't been confirmed yet. It's either the first week in May or the last week in April, but I think that this quarter will be second quarter, consecutive quarter where things are picking up again. And so I like Wynn, and I am bullish on the gaming industry here in the next 40 plus days. And yeah, I actually started my finance career in the gaming industry. I did a 3-month internship in equities, sales, and trading. Equities are just stocks, and the bank I was at covered exclusively the casino stocks, so I learned a lot about them. It's a great sector. It's kind of a less widely known sector, but it's a very volatile sector, a good sector to trade. So I'm always watching when, all the casino stocks, because they are volatile. So Rick, it should be 0% on top. Yeah, it should be 0% on top. Because 100% would be to the all the way down to where you're bringing the swing low from. So it should be 0% on top, and you want to see it go once it gets down to the 50% retracement level. That's kind of a place where you can say, okay, this is a good place for me to start putting on some bullish trades. And then you can put your stop at the 618. If it closes below the 618, now there's a higher probability that the trend is going to reverse. And so if it closes below the 618, you can stop out of the trade and assume now that once it closes below the 618 that we may be starting a new downtrend, because we've kind of violated the 618 level, which is this is like the most important level on Fibonacci's is 618, because like the way math works and everything, you see 618 everywhere in the universe. It's not just stocks, but it shows up in the stock market as well, but it shows up everywhere, which is just crazy. That if you look at like the guy's name, Leonardo Fibonacci, he found that the 618 was like everywhere. So yeah, that's kind of what that is. And that is that. So we've been going for an hour now. Yeah, definitely, right. And if you have any questions, you can ask me when I'm in the chat. I'm in the chat every morning from 7:30 to 8:30 Eastern. So feel free to come in there, or you could also just for these videos as well. Every weekend I'll be here. You can ask more about them whenever you want. I know we have 4 other people in here, but I haven't seen any questions from anybody else. Does anybody else? Were you guys able to follow this okay today? Is there any way that you think I could make this more understandable or comprehensible, I guess is the word I'm looking for? Is there any way, was this easy enough to follow, or was it too complex? So I'm trying to make it like so everybody can understand and follow it. So please feel free to give me any input, and I would love to see questions from other people as well. Although I'm fine with just Rick keep giving me questions. That's what I'm here for. So I'm really here to answer anything that you guys want to cover. That's the primary focus, is to coach you guys up and provide you with any help that you feel like is necessary. So the more questions you ask, the better. Because like I said, I could just record a video where nobody interacts. So that's kind of the benefit of going live. And we have about 5 more minutes here. So what I'm going to do is I'll give you guys an example of a properly planned trade. We're not really going to cover the strangles today. We don't really have enough time. At some point, we'll get into these strangle things. We'll get into the strangle strategy. If you want to read more about that, I can post a link. And I can just I'll share this PowerPoint so you can read about it in the PowerPoint if you want. And I'll post a link to where you can read more about it. I'm not going to get into that today, not enough time. But I'm going to give you guys another example of a properly planned trade. So we're going to use Wynn here. We're going to say our stop is the $2 move down, right? So like I said, the first thing when we're ever planning a trade that we're going to enter is where is the stop, okay? Whether or not you're doing it with the notifications, when the notification we send out the Standard Oil Exchange, you still need to, before you get into them, you still need to know where is your stop, Okay. And that's fine if it's different than what we say. It doesn't matter. You should be practicing and understanding where you want to make your stops and what you think is a good place to put it. And then look at ours and see kind of how and then you can compare them and see, if you're seeing something different, or if you agree with us and now it just helps you understand it more when you try and do it independently, where you plan your stop. But I would recommend, when you're planning your stop, to use the trades we send on the notifications and then try and come up with your own stop. And then when we give ours, kind of compare the two, right? And then that's kind of a good exercise, I think, for you eventually to get as efficient as possible at doing this. But if you're ever making trades independently, the first thing you need to do, like I said, is identify the stop, identify how much you're going to lose dollar amount, and ask yourself if you're okay with it. And if you're not, move it down. Like, you need to actually picture yourself having lost that money. And if it's too much, then risk less, obviously. And I think you'll find that you're really not okay with losing as much as you initially thought you were. I can tell you, I hate losing a lot more than I like to make money. I hate losing it more. And I think at some point you need to come to the point where you hate losing it more. And I think if you haven't yet, you just haven't had enough setbacks, or, I don't know, maybe some people will never come to that point. But I think once you get to that point, it's a lot easier to manage your risk and be more disciplined. So, example here, we're using a $2 stop on Win, which is about 114.75, a close below on the daily. We're doing a call spread, 117, 121 for the May 5th expiration. And the risk here is about $50 per contract. So we know all that, right? We identify our stop first. Our target is, before we get into our target, we want to, as much as possible, always have a 2-to-1 reward to risk. What this means is that if we know we're risking $2, we want our reward to be $4, right? If we keep it 2-to-1, that means we only need to be right 33% of the time to break even. So reward to risk 2-to-1 is a really good place to always try and be. So if we're risking $2 on Win, we want to see ourselves make 4, ideally. So our target on Win is going to be 120.85. And to manage the trade, once Win gets 50% to the target, which is 116.75, I'm going to move my stop up to 115.75 to lock in at least some profits and guarantee myself that I don't lose money. And then if it goes up 75% to the target at $3, let's say it's at 119.85, then I'm probably going to move my stop up even higher to 117, right? Yeah, 117 is, sorry, that should be 118, right? No. Yeah, if it's, so 50%. Yeah, that should be 118. So this should be 118. Yeah, this should be 118. So yeah, so once the trade gets to 118.75, and then I'll make sure we stop at 117.75. So yeah, because it's at 116.75 now. Once it goes up $2 to 118.75, I'm going to make sure I stop out at 117.75, locking in $1. And then once it goes up to 119.75, where it's 3/4 of the way there, then I'm going to move it up to 118.75. So I'm locking in at least 50%, right? Just remember, guys, professionals take profits, okay? The last thing anybody should be doing is allowing a winning trade to turn into a loser. Please do not let that happen, okay? Put in a hard mechanical stop if you have to. Just make sure that you're not losing money once you have a winning trade. Winning trades need to be kept winning trades, okay? So another example of a properly planned trade. Does anybody have any questions before we end this session today? Yes, Rick, I will share this PowerPoint in the chat, and I'll start like maybe posting these rules in the chat every morning when I get here, if that helps too. Maybe I can do that. And yes. But that's good. I'm glad that you're asking me to do that, Rick, because that shows that you're moving towards being disciplined if you aren't already. And you're definitely making progress if you want that to be printed out and you want it to see it. And that's it. Yeah, definitely. When you establish your rules and your plan, that needs to be in front of you. It's like your blueprint, right? You need to review that every day. You need to stick to those rules and stick to those plans. So, does anybody have any questions before we end this session today? No problem, Rick. Happy to help. Happy to help. Jeez, you know what's going to be my goal, guys? My goal is going to be for everybody watching. I don't want anybody to be a ghost, okay? As far as I'm concerned, it's me and Rick and 4 ghosts right now, because I don't know what's. You guys could have, the other 4 ghosts in here. You guys could have watched this at any time, right? I mean, you guys weren't able to. I mean, it's fine. I understand. You know, maybe you don't have questions. Maybe you might not feel comfortable asking questions, but it makes me sad because I'm here for you guys, and the other 4 people in here, I feel bad that you guys either weren't comfortable asking questions, or whatever it may be. I'm sure that all 4 of you probably had some type of questions. So, and if you didn't, then okay, that's fine. But if you did, then I'm sad that you didn't ask them, because there's 5 of us. Well, I mean, yeah, there's 5. That doesn't count me as watching, right? So it should be Rick and 4 others. But either way, if it's Rick or 3 others, I feel sad. You know, you other people are a ghost in here right now. And I'm here to interact with you all, and I want to help you all. So please, 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 moving forward, please come in here and ask questions and interact with me. That's what I'm here for. I'm glad Rick took advantage of it. That's what I want everybody to be doing. I mean, Rick pretty much just got a one-on-one 60-minute session. So, and I mean, this is content for everyone to review, but Rick was able to interact with me, and I'm glad I was able to help him. So that is going to be it for today, guys. I hope that next time everybody that's in the chat asks me questions. I want to interact with you guys. I want to see everybody do well. I hope that this helped everybody. Please, 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 if you don't have money management and trade management rules and a plan for yourself, please put that in place. I would highly recommend using the rules I gave in this video. It's going to help everybody stay in the game for a long time. Okay? Now, everybody enjoy the rest of your Sunday. I will be in chat tomorrow morning at 7:30 Eastern. If you have any questions then, feel free to ask. And look forward to having another great week with you guys. Like I said, the market has been in this range-bound period now for the past 4 to 5 weeks. So we should start trending here sooner than later, because it's been a while now where we haven't gone anywhere. So that's going to be it, guys. Everybody have like I said, great rest of your weekend.